Shawn here, head trader at the Apiary Fund. So great to be with you today. We're going to talk a little bit about how to trade consolidations. This is kind of a continuation of our discussion last week. We talked a little bit about the summer doldrums, and if you've been trading this last week, you have seen loads and loads and loads of consolidations, and we're I thought it might be a good discussion to kind of discuss how to identify different types of consolidations, and then what are some common patterns that we see after the consolidation, and how do we take advantage of those patterns. So that's what we're going to be talking about today. For those of you who are out there, we are doing a trader live, or I'm sorry, a trader on the street. We're going to do a Trader on the Street next week in Denver. We're so excited to be heading out to Denver, and looking forward to meeting all the good Coloradoans here, and looking forward to trading with you for a little bit out there in Denver. So, and then shortly thereafter, we've got the Trading Summit coming up. We're super excited about that. We've got over 100 people flying in here to Salt Lake City. We've got this huge auditorium reserved. We've got the best internet in the city. And we all bring our laptops together, and we trade and we get up early in the morning, which is crazy, to see a bunch of us kind of dragging ourselves in at 6 o'clock in the morning here in Utah, and pulling up the computers. But it's so much fun. We really enjoy these trading summits. It's just a great time to meet everyone. You're all over the world. In fact, I don't even know, maybe just type in real quick where you're from and the end of the chat box, but you can kind of see we're all over the place, and so it's really nice to kind of come together for a trading summit and get to know you a little bit better. So yeah, we're looking forward to that. That's August 13th here in Salt Lake City. We're super excited, like I said. So let's talk a little bit about consolidations. We've got, like I mentioned earlier, right now we're in the summer doldrums. It's the middle of July. It's hot. Everywhere it's hot. And the markets are just kind of melting into nothing. There's no volatility whatsoever. And how do we trade that? And what do we do as traders when we see, the lack of volatility that we see right now? So the first thing we have to do is we have to learn how to identify the consolidations. So there's really two basic types of consolidations, and for those of you who've been with the Apiary Fund for any length of time, you understand this concept that there's this alternating pattern between expansions and contractions, and expansions, contractions, and it just alternates. The markets are constantly alternating between these two states of market character. So contractions are basically, we can think of them as consolidations. So the market expands, it consolidates, and then it expands again. We don't know which direction necessarily. The law of expansion contractions doesn't necessarily tell us which direction the markets will expand, but it does give us an idea of what's coming up next in our trading or on the charts. And so consolidations are basically just, you've got an expansionary period, market's moving up, and then you get a consolidation where the market just moves sideways. Right, maybe some alternating bullish bearish candles, but you can see that there's like this general tendency before it's in an expansionary state, and it changes into a consolidation state or a contraction state. So this is one type of consolidation. Whether that happens over 1 bar, 3 bars, 5 bars, it doesn't matter. A one bar consolidation is really hard for us to see. So, but regardless, you'll see that consolidation even in a one bar move. You may look at it and see like this, and then that second bar, the market moves down. But if you were to look at this period right in here, on a smaller time frame scale, you'd see, maybe some ticks going like this. If this is linear time, you'd see all of these ticks happen, and then you'd see that market break down. So even though it's only showing one bar, that's still a consolidation. You'd still see that on lower time frame charts. So one thing you'll have to learn is if you trade higher time frame charts, in order to really see good consolidations, you might have to drop down to lower time frames to see those consolidations better. But there's two basic types of consolidations I want to make sure we identify today. The first is, change a setting here real quick. The first is a bar, what I would call a bar consolidation, where you have a bar and then you have a series of bars after that that all fit within that same bar. So you can see there's the bar high, the bar low, and then you have subsequent bars, and they're all contained within the high and the low of the initial bar. So that's clearly a consolidation. And you can contrast that to another type of consolidation where it's called a range consolidation, where you have a range that's moving in a consolidation pattern. So this is a range because none of those subsequent bars are contained in one big bar, but you have a range up, a range down, a range up, a range down. But that's still a type of consolidation. So let's pop over to the Alveo platform, and let's see if we can see a couple of examples of this. We had them just this morning. I was looking at it. But you can see right here, this is kind of the range consolidation. We'll just draw the ranges in there, but there's a range up, range down, range up, range down, range up, range down, range up, down, up, down, up, down. So nothing is really none of this price action on a range consolidation is encapsulated in one single bar. So we don't see one single bar that encapsulates it all like a bar like that. But you get a range, and all of the ranges have similar resistance levels, and they all have similar support levels. And if you compare that to over here, we have more of a bar consolidation. You see all of the bodies inside this bar. I don't know. On your end, it might be a little hard to see. Let me see if I can zoom in on it a little bit. But you can see all of those bars are almost all the exact same. They all share a center point, right? So that's more of a bar consolidation. So, as you're trading, look for those two types of consolidations. A range, which will be more like this. You'll see up and down movement, and as opposed to a bar consolidation where you see, a bar followed by a whole series of subsequent bars that are all kind of the same height. So both of those are consolidations, and both of them will be important for us to recognize as we're trading. Now, consolidations, a lot of people get really frustrated with consolidations because the market doesn't move anywhere. And so it's really hard to make money when we're trading if the market isn't moving anywhere. And so, hence we all get frustrated with the consolidations. But what I'd like to propose for you to do is just change that thinking around a little bit. And because when I see a consolidation, I start to get excited because I know that the market is defining some really good opportunities in the near future. Near future, maybe 1 minute, maybe 20 minutes. I don't know when that near future is. The consolidations can last a very small period of time or a long period of time. But the nice thing about it is that if I see a consolidation, then I know that I've got a good trade coming up at some point. And it's my job to catch the new expansion that evolves from that consolidation. I think mentally, if you can imagine this in your mind, you've got all these traders that are just getting antsy. You know, they've got the market going sideways. They're getting antsy, and they're like, we got to get some movement here. And so, you know, they start throwing some money at it, and that creates the next expansion phase of the market. And as trader, I like that because the consolidation helps me pinpoint, you know, really good pinpoint of where to get in on the next expansion. So let's talk a little bit about how the market transitions from these consolidations into an expansion. They're really the way that the market it transitions. It makes that transition is as diverse as the grains in the sand of the sea. There are so many different ways that we can see that consolidation breaking. But there are some commonalities that you'll like to see, and I kind of bunch them up. The way the market breaks, I've kind of bunched them up into like 4 different patterns that I typically see. The first is a whipsaw. You'll see that all the time where you've got a real nice consolidation. Let's just look at this right here. You get a real nice consolidation pattern, and then the market breaks the high or the low of the consolidation pattern, and then it falls back down in. So that's a whipsaw, and that's something we have to deal with as traders. We have to learn how to manage whipsaws effectively because they happen regularly, especially if we're looking at these consolidations. They happen so often. So how you manage your whipsaws will, in large effect, determine how successful you are at the end of the day. If you allow those whipsaws to constantly give you big losses in your account, then you're going to take some heat. You know, you're going to take some losses in the account, and you'll end up, you'll end up doing a lot of work for very little profit. So the trick is that, cutting any kind of whipsaw, making sure that you cut that short. You don't want to hold on to them for long periods of time, 5, 6, 7, 8, 9, 10 bars, and then pretty soon the market breaks and moves down on you. That's a real problem. So learning, we can use some future YouTube Lives presentations. We can talk a little bit about some strategy or some techniques that we can use to protect ourselves from these whipsaws. But regardless, whipsaws are a part of life, and I suffer from the false breakouts. You suffer from them. All of us do, and so I've just learned to, count them as part of my win-to-loss ratio. For every 100 trades, I'm going to suffer negative consequences from 5, 6 whipsaws. So that's the first thing. That's the first type of break we typically see. The second type of break is what I call a momentum burst, and I want to show you this consolidation, this range consolidation that we have here. So we see the market in a nice consolidation range, and then all of a sudden we see the very strong candle form coming out of that consolidation. That's a momentum burst. If you're trading stock, you typically see, high volume associated with that type of a candle, or at least higher than normal. If you're looking at indicators, you'll see, that candle will represent 2 to 3 times the normal ATR of the consolidation range. So you can use these techniques to kind of help you validate that it's a momentum burst candle. But, often is the case, you only get one or two candles after the momentum or after the break of the consolidation. You only get 2 or 3 candles worth of profit, typically, of good profit. So sometimes what you'll have to do if you're going to catch that momentum burst candle is you'll have to make sure that you have a buy stop or a sell stop placed. A buy stop if you're breaking to the upside right here, a sell stop if you break into the downside down there. So one technique that you can use to capture that momentum burst candle is to use a stop entry point or a stop entry order to get into the trade as that burst candle is forming. So that's the second common pattern that we see as the market breaks. The third one I want to talk about is what I call a trampoline move, and it's kind of like a whipsaw, only it's a little different. But here we've got a consolidation, a bar consolidation right here, and then what you'll see is the market breaks it to the downside, and then reverses and breaks it to the upside. So you get the market moving down in a strong momentum burst, but it's followed up by an opposite candle right here. So down, down, up, and it retraces everything. So oftentimes when I see that type of a pattern form, what I'm looking for is I'm looking to cut my losses, back in the consolidation range, cut my losses. Or, if that trampoline's big enough, maybe I can book a little bit of profit in that. Maybe. Just, it all depends on how that forms. But regardless, I'm also now have a little bit stronger conviction that the market will be going the opposite direction. And so I usually set up a nice buy order on the opposite end of the consolidation there. So anytime I see that trampoline, and a trampoline is real simple, you have strong movement one direction and then immediately a strong movement the opposite direction. So that's why the trampoline, you're jumping on the trampoline, you move down, and then all of a sudden it shoots you back up. That's why we call it the trampoline. So that's another type of pattern you see, common pattern you see as the market's breaking these consolidations. The final one is what I call a pressure mount. And let's see, I don't know if I saw any real good example of a pressure mount. This one might be a good example here. So again, dropping to the downside, the market's breaking the consolidation to the downside, but it doesn't break with any kind of strength like the momentum burst. So that candle's not any bigger or smaller than all of the previous candles, but you kind of see it leaning on it, a little bit of a trampoline effect right here, but it reverses and there's no follow through on the trampoline, but it's just kind of leaning on that market. It's just mounting a little bit more and more pressure, and then all of a sudden the candles start to grow after that. These are tricky to trade because you're like sitting there, market's breaking out of these consolidations. You're like, it's not really strong. It's not a real strong move out of the consolidation, but it's still holding its pattern. Then the next candle forms and you're like, oh geez, it's not building any strength. Then the next candle forms and you're like, oh my gosh, I don't know if this market's even gonna, if it's just moving back into a consolidation or what. But you go through this psychology of you're like second guessing yourself with any time you see that type of mounting pressure. But if it's a good mounting pressure break, then what you'll see is that eventually after 3 or 4 candles, you'll start to see some consistency being built into the direction. So you see consistency here, 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 so that you get all that pressure building on it throughout this section, and then you get some consistency in bullish or bearish candles coming out of it. So those are 4 different ways that we see the market breaking consolidation patterns. So let me just kind of recap real quick, and then I'll ask some of the guys here if there's any questions that I can address. But 2 types of consolidation patterns that you like to look for. The first is a bar consolidation, and simply all that means is that you've got a big range bar, and you've got a whole series of bars following that big range bar that neither go higher nor lower. So all the subsequent candles could be, you could take them and you could move them all to the left, and they would all fit inside of the big range bar. It's just like shuffle them all the way back, and they'd all fit nice and snug inside that initial range bar. As opposed to a range consolidation where you have a series of consecutive bullish candles, consecutive bearish candles, consecutive bullish, but all the peaks and all of the valleys of those ranges and the reversals, all the peaks and the valleys are all linear. They're all going sideways. They're all lined up sideways. So those are the 2 types of consolidation patterns that you see typically. And then, of course, we want to be right on top of the trade as that market breaks the consolidation patterns. And we talked about 4 different ways that the market breaks those consolidation patterns. The first being a whipsaw, right? So it's not a true break. It just breaks and then comes right back into it. Those are discouraging as traders, but we have to learn how to manage those. And they typically, if you're there in the moment watching him, that's a real break, right? You can't ignore that. It's a real thing. It's really breaking it. But it comes back down and closes inside the range again. So that's the first one. The second one is obviously the momentum burst. So you see that consolidation, then you see a huge range bar, 2 to 3 ATRs, 2 to 3 times the size of the consolidation bars that come before it. So that's a real solid, good, strong movement coming out of the consolidation. The third pattern is the trampoline, where you get good decided movement through. It closes outside of the consolidation range, but then immediately turns and heads right back up. Trampolines are a good way to kind of reverse your position. You take some losses on one side, but reverse your position, get into the other side. The final pattern that we see is the pressure mounting. So you see the market forms a new high, it comes out of consolidation to the upside, forms a new high, forms another new high, forms another new high, but there's no momentum behind it. It's just so weak. Eventually, all that pressure it's building, all that mounting, that pressure is mounting, and you'll start to see it. Hopefully, you'll start to see it build, bigger and bigger candles in the direction of the new expansion. So there you have it, traders. Those are some important things to know during the summer doldrums here in July, sweltering July. Always fun to trade. Always fun to trade these consolidation breakouts because it gives you some good timing in the market. You know roughly, or not necessarily timing. It gives you good opportunities in the market. You know that there's a good opportunity coming up when you see that consolidation form. That opportunity, someone's going to break that. It won't stay there forever, and so it gives you an opportunity to be watchful. Keep your eye on it and be right there with your trade when the new expansion forms. So, do we have any questions from the hive? Anything that you guys notice out there? Any questions?
One person asks, explaining the wicks and when to pay attention to them.
Okay, so there's a question about wicks. Obviously, anytime you get a whipsaw, those are high wick scenarios. But what I like to do to identify the upper and lower range of the consolidation is I just kind of like to draw a line with the most data points. So I draw a line and connect the most data points. So I could draw that line right here. I've got a wick low, a body low, a wick low, close to a wick low, wick low, wick low, wick low, body low, but a wick. Wick is beyond it. So really what I'm doing is just drawing however I can draw that line so that it touches the most endpoints, whether it's a body endpoint or a wick endpoint. So that's my rule for that. I don't necessarily disregard wicks. I'm not the type of person that says, the type of trader that says that the only important point is a body close. But what I do like to do is I like to find a confluence of pricing, and I like to draw my lines there. So hopefully that kind of gives you an idea. We can talk about that in another one. By the way, we'll go back and look at these recordings, and so you can go ahead and type questions in the recording that we put on YouTube, and sometimes I'll use those or as ideas for future webinars or future presentations like this. So go ahead and type those in, type your questions in, and also if you have any suggestions on what to cover in future events like this, I'd love to hear those as well. I think let's wrap it up for the day. Great to be with everybody today. Happy trading. We'll see you next week. Thanks everybody. Bye now.